What's up everyone, welcome back to another video with the Millennial Finance. In today's video, we'll be talking about whether you should invest your money in one lump sum, meaning in one go, or dollar cost average it. Cha-ching! First off, let me explain what dollar cost averaging is. It's a simple investing strategy where you invest your money at regular intervals over a period of time. For example, dollar cost averaging into the S&P 500 can mean investing $100 every month or $50 every 2 weeks. So why do people do this? Basically, they want to remove the risk associated with trying to time the market and potentially buying at a very high price. Imagine two investors trying to invest $1,000 into stock A. Investor number 1 decides he's going to put the entire $1,000 at the first day that he decides to do it, while investor 2 thinks that he wants to dollar cost average and invest $300 every 2 days. Since the price of the stock dropped over this period, the second investor actually bought the other batches of his purchase at a lower price for an average cost of just $6.67. In this instance, we can actually see how dollar cost averaging helped investor 2. Even though that at the end of the period, the stock price ended at the same $10, Investor 2 is actually making money on his investments already, while Investor 1 is only breaking even. However, this would be the exact opposite if the stock price went up after the first day instead of down. Still, Investor 2 is okay with this because he knows that he's minimizing the risk of buying the stock at a very high price and that over a long enough period of time, he'll get a very good average price on his investment. So, which method is the best for you? I'll go through two different scenarios of when you should either dollar cost average or lump sum invest, where the first one is for people who don't have a large amount of money stashed away, where they actually want to put in every single month a portion of their salary. Let's say you want to invest $100 every single month from your salary because you've been watching the Millennial Finance. So what do? Do you save it up and only buy when the price is low? Or do you just invest this $100 every single month regardless of where the stock price is at? To answer this, I actually went through a very interesting article by someone that I follow on Twitter called Of Dollars and Data, where the name of the article is Even God Couldn't Beat Dollar Cost Averaging. Basing this entirely off of historical data, he ran two different simulations for two different types of investors. The first one put in $100 into the S&P 500 every single month regardless of what the stock price is. The second one is apparently the best stock market picker in the world and saves up this $100 every single month and only invests when the S&P 500 is at the bottom before making another all-time high. This means that the second investor is a so-called God investor because he knows when the exact bottom is. The findings of this research is very interesting. In many cases, the investor who put in $100 every single month and wanted to DCA actually beat the one who tried to market time even when he knew where the bottom was. This is because when you're trying to look for the absolute bottom before the S&P 500 hits another all-time high, you're actually missing out on a lot of the gains because the stock market will always just keep on going higher. This is of course based on historical data, and I'm not saying that it will continue forever and we can just invest whenever we want. We always have to do our research, so make sure you do that before making any investment decisions. And of course, no one can tell where the market bottom is, even Warren Buffett. This is why in most cases, especially for those of us, even ourselves, we should just put in our money every single month and not try to time the market. We can't always wait for a crash before we decide to invest because we never know when it's coming, even if stocks may look very overvalued right now. This is only a scenario. Whoa, when is it so loud? Now, this is in a scenario where we only have $100 to invest every single month and we have nothing saved up. What if you have a lot of money saved up in your bank account because you've been watching the Millennial Finance and you think now is the right time for you to invest? Should you put it all in one go? Or should you dollar cost average it to minimize your risk? Multiple researches have been done and they come to a very similar conclusion. You should always invest your money as soon as possible, meaning lump sum it. Wait, but why is this the case? It's because that generally, the The US stock market has always been in an upward trend. Because of this, it's always logical to put your money as soon as possible, and there's no point waiting to enter the market, right? With a never-ending upward trending stock market, dollar cost averaging your savings into the stock market actually means you're buying your shares at a higher price. Imagine the scenario that I was showing you guys earlier, except the roles are now reversed. Instead of the stock price going down, it's actually going up on and on and on. This is the case most of the time for the S&P 500 and the US stock market in general. Looking at the example of the S&P 500, why would I want to DCA my money when I can just put it in as soon as possible, right? So, historically, based on facts, investing your money lump sum is actually the better choice for you so that you can get better returns, and is also the most rational decision to make. However, I want to make a counter argument to this. Most of the times, human beings aren't rational. We're all emotional, and whether we like it or not, our emotions will impact our investment decisions. Sure, on average, it's usually better to just put your money lump sum, but what if you're unlucky and this isn't one of those times? Imagine saving up to $100,000 and putting it under your pillow just to finally decide to put it all in the stock market in early March of 2020. In barely just a month, your $100,000 which you've worked so hard to save is now down by $35,000. This could cause you to question investing. Is it even worth it? Am I even doing it right? Maybe I just shouldn't do it at all. If you chose the DCA method instead, you'd find comfort in the fact that you didn't actually invest all $100,000 immediately before it crashed, and you know that you have more money to invest when the stock prices are lower. So in my opinion, dollar cost averaging is actually the better way to go, even though most of the times it will cost you some returns. It gives you something that is invaluable, which is peace of mind to make sure you stay in the game. At the end of the day, our goal here is to ensure that we continuously invest our money for the long run, and if the cost of it is a few extra percentage points of returns, then so be it. Having said this, I still don't really recommend splitting your investments over too long of a period. Most experts suggest that we don't split our investments for more than 12 months, and to me, it actually depends on how much money we're talking about. If it's just $10,000, then maybe we can just split it into 3 months of $3,333 each. If you're talking about $100,000 or $1 million, then maybe doing it over the course of an entire year can be better to again give us that peace of mind. Another benefit of dollar cost averaging instead of lump sum investing and waiting for the market to crash is it actually reduces the chances of you missing out on a stock that's going to bring us massive returns. A good example of this is to actually look at stocks that took a real beating in March of 2020 only for it to recover very quickly and even more after investors realized that the companies will actually benefit from lockdowns. Let's take an example of a stock that I invested early on when it was beaten down, being C Limited. Before everything went bad, the stock actually was trading around the $52 level before going all the way down to $35 at the bottom. When I found out about it, it had actually recovered a bit more to around the $40 mark. As I of course didn't know that the stock market was going to rocket from there, I actually decided to put a small starter position in this stock at $40. To continue building onto my position, I thought to myself that I would just continue adding to this position whether the stock was going up or down. Soon, the price of the stock hit $60. I told some of the people close to me that, hey, you should look at this company because it's doing really well in lockdowns. Some of my friends looked at the chart and saw $60 and told me that, it's gone up from 40 to 60 so quickly, I'm just gonna wait off until it hits back 40 and then I'll buy. Well, that didn't happen. It continued going up and up and up, and it never got the opportunity to invest while I continued dollar cost averaging. Today, the stock is worth well over $200 a piece, which is 5 times the price it was when I first bought it. Now don't get me wrong, I'm not saying that I'm a master investor and I knew that this was going to happen, because honestly, I didn't. The only thing I did was that I was dollar cost averaging into the stock whether it was going up or down, and I eventually built my full position. Of course, if I knew at the time when it was $40 that it was going to go up all the way to 200, I would have just put all my money in, but hey, that's hindsight. No one knows what's going to happen. If you were someone who found out about this stock at $60 but decided that it was too expensive and were trying to time the market, you would have missed out completely. Instead, another investor who decided to just put in money every single week or every single month is sitting on a nice piece of returns. Of course, this is only a very good example of how dollar cost averaging will work. It'll not work for everything, and of course, if a company is actually a dud and reports bad earnings every single quarter, for example GoPro, then this method won't work. Yes, you'll be dollar cost averaging into a lower stock price, but the price of the stock will never recover because the company is just not doing well. Make sure you do your own research on the company, and you can only execute any of these strategies once you're comfortable with investing in a company. Personally, I practice a lot of dollar cost averaging in my investment portfolio. For example, I have a standing deposit scheduled with Stashaway to direct debit my bank account every single week so that I can invest in their portfolios. This ensures that I always get a good price for the ETFs that they buy, and it also actually helps me with forced savings. For stocks, I also deposit money into my brokerage account every single month where I'll then spend it to buy some stocks. To be honest, I kinda also do this because I actually love the process of buying stocks. I don't want to put up all my money up front and just invest it in one go, because then I'll have no more money to invest for the rest of the year. Whenever the stock market is seeing a red day, of -2 or -3%, it actually feels like a shopping day for me, similar to 11/11. That's it for today's video, guys. I really hope that it helped you in making a decision whether you should invest your money lump sum or dollar cost average it. Let us know down in the comments below. Which investment style do you prefer? If you guys enjoyed this video, give us a big thumbs up and subscribe to our channel if you haven't already. Also, you can watch some of our other videos which I'll leave right here. Thanks for watching till the end, and see you guys in the next one. Peace out.